Last month, the United States economy unexpectedly lost 23,000 jobs. Wall Street economists had expected the economy to gain over 80,000 jobs. To make matters worse, previous reports were quietly revised down by over 100,000. Yet, the headline unemployment rate actually dropped from 4.2% down to 4.1%. Welcome back to How Money Works, where the economic math seems completely made up today. How can an economy lose tens of thousands of jobs while unemployment looks cleaner on paper? If you look at the official numbers, everything seems like a confusing puzzle right now. The truth is that the job market did not suddenly get healthier last month. Instead, nearly 300,000 American workers simply gave up and walked away entirely. When people stop looking for work, the government no longer counts them as unemployed. That statistical trick created the illusion of a strong labor market during a massive contraction. Over the past 2 months, nearly 1 million workers have vanished from the official labor force. Economists are currently scrambling to figure out where all these missing workers actually went. Some older workers decided to accelerate their retirements and leave the workforce forever. Strict government immigration crackdowns also reduced the total number of available new job seekers. Many frustrated job hunters simply stopped applying after months of getting zero responses. The labor force participation rate fell to 61.4% last month. That represents the lowest level of workforce participation seen in over 5 long years. When fewer people compete for open positions, the mathematical jobless rate automatically goes down. It is a mixed blessing that actually limits how much the broader economy can grow. If you currently have a job, your position is probably safer than usual today. Layoffs remain low because companies fear the painful labor shortages from recent years. Employers are desperately holding on to staff even as overall business demand slows down significantly. Economists now call this strange economic environment a low hire and low fire stasis. If you are already inside a company, you enjoy unusual safety and job security. However, if you are on the outside trying to get hired, times are tough. Nearly 3 out of 10 unemployed Americans have been searching for over 6 months. That is the highest share of long-term unemployed workers since the pandemic recovery. Young adults and recent college graduates are taking the absolute hardest hit right now. Unemployment for young workers without prior work experience remains stuck near 24%. Recent graduates are sending out hundreds of resumes into a digital void without answers. Instead of pulling marginal workers in, the hiring pipeline is shrinking across the country. When you look behind the headline numbers, specific industries are getting hit very hard. The biggest drop came from local government education, which shed 50,000 roles. Some analysts believe this massive drop was just a seasonal fluke from summer school calendars. However, private sector businesses also showed extreme weakness across major consumer-facing industries. Leisure and hospitality employers cut 40,000 workers after suffering heavy losses in June. The temporary economic boost from the World Cup tournament has completely faded away now. Restaurants and hotels are seeing lower-income consumers cut back on discretionary summer spending. Retailers also shed over 19,000 employees as store sales continued to stall out. Financial services companies cut 14,000 jobs as higher interest rates squeezed corporate deals. Even tech companies have eliminated nearly 140,000 positions so far this year. Corporate giants like Amazon, Meta, and Microsoft account for tens of thousands of those cuts. Yet, there are weird bright spots hiding inside this otherwise bleak employment report. The construction sector actually added 22,000 new jobs during the month of July. Manufacturing also managed to gain 5,000 roles despite a slowing broader economy. This specific growth is being driven almost entirely by the massive artificial intelligence boom. Big tech companies are spending hundreds of billions of dollars building physical data centers. They are cutting corporate middle managers while hiring hard-hat workers to pour heavy concrete. The tech industry is reallocating capital away from human workers and into AI servers. Tech executives argue that artificial intelligence allows them to gain massive operational efficiency. However, top economists warn that AI claims are often just an easy excuse for overhiring. Companies that blamed artificial intelligence for layoffs actually underperformed on the stock market. While hiring has stalled out, worker paychecks are also completely failing to keep up. Average hourly earnings increased by just 2 cents across the nation last month. That brings annual wage growth down to 3.2% for American workers. That is the slowest pace of wage growth recorded since May of 2021. Normally, slowing wage growth would help cool down overall inflation across the nation. However, consumers are still paying higher prices for gas and essential daily goods. Inflation remains elevated around 3.5% due to ongoing international conflicts. The conflict in Iran has kept crude oil prices hovering near $90 a barrel. Gasoline prices have surged up 36% to over $4 per gallon. When your wages grow slower than inflation, you are taking a real pay cut. Lower-income households are feeling squeezed by rising energy costs and elevated grocery bills. Meanwhile, higher-income families continue to spend money thanks to strong stock market gains. This K-shaped economy is creating two completely different financial worlds in America today. This messy economic picture places the Federal Reserve in an extremely uncomfortable position now. Central bank officials have been aggressively focused on bringing inflation down to 2%. Several Fed governors recently argued for raising interest rates again at their September meeting. They believed a strong labor market gave them full permission to keep tightening policy. However, an unexpected loss of 23,000 jobs completely threw off their plans. Federal Reserve Chairman Kevin Warsh now faces a massive dilemma before the next vote. If the Fed raises rates to fight inflation, they risk causing a severe recession. If they hold rates steady, elevated energy prices could keep inflation running hot forever. Traders on Wall Street quickly lowered the odds of a September rate hike following the report. Stock market futures actually rallied because investors prefer lower interest rates over good news. Bad news for working families turned out to be good news for Wall Street traders. This report marks the second year in a row with massive summertime statistical revisions. Last year, the government revised down earlier summer jobs numbers by nearly 300,000. That massive drop caused President Trump to fire the head of the Labor Statistics Agency. This year, May and June numbers were slashed by a combined 103,000. Monthly job revisions happen routinely because many surveyed employers submit their hiring data late. However, 2 consecutive years of huge summer revisions make economists question the underlying models. It creates a foggy environment where nobody really knows the true state of employment. A consumer survey showed that more Americans now feel jobs are hard to get. Confidence splits are at their most negative levels seen since the early pandemic days. Consider what is happening at the world's largest private employer right now. Walmart recently brought thousands of workers to its corporate headquarters in Arkansas. Executives told store employees that artificial intelligence would improve their daily jobs. They insisted that automation would not take away their hourly retail positions. Yet, Walmart spent $44 million last year on a single AI executive. That single executive earned more money than the company's outgoing chief executive officer. At the same time, shareholders requested reports on how AI affects store staff. Walmart tech and product design teams recently announced hundreds of corporate layoffs. Companies across the country are cutting staff to free up cash for technology investments. The money to build expensive artificial intelligence systems has to come from somewhere. Big tech giants expect to deploy over $700 billion in capital spending. To afford those massive server centers, companies are trimming human headcounts across corporate offices. They are moving from one big technological bet directly into the next big bet. Small business owners are also caught directly in the middle of this economic squeeze. Consider a heavy industrial construction company operating out of Louisiana this year. Business slowed down last year due to tariff uncertainty and rising material costs. Rising prices depressed their need for new workers and froze general hiring plans. Many small companies focused entirely on keeping their existing trained workers instead of expanding. While some industrial projects restarted, overall business confidence remains extremely fragile across regions. Higher borrowing costs make it expensive for small firms to take out equipment loans. When commercial interest rates remain high, expanding a small business becomes very risky. Owners would rather overwork their current staff than hire new full-time employees today. This low hiring environment is creating a clear divide among American consumers today. Higher-income households continue to spend money freely due to record stock market gains. Their investment portfolios and home values shield them from rising daily living costs. However, lower-income households are facing severe budget constraints from elevated energy prices. Tariff-driven price increases have forced working families to cut back on discretionary spending. Gasoline prices jumped following the outbreak of military conflict in the Middle East. Higher fuel costs act like an immediate tax on every single working family paycheck. When gas prices eat up disposable income, families stop eating out at local restaurants. That drop in consumer spending explains why leisure and hospitality lost 40,000 jobs. It is a domino effect that ripples through the entire service-based economy. For young workers entering the labor market, this environment feels like a trap. A few years ago, fresh college graduates received multiple competitive job offers instantly. Today, outstanding students with perfect grades struggle to land a single phone interview. Companies that were hiring graduates rapidly have completely shut down their entry-level pipelines. Because employers refuse to fire existing staff, open positions rarely become available. At the same time, companies refuse to add new roles due to economic uncertainty. Young job seekers are stuck in a frustrating, endless cycle of ghost job applications. Many turn to advanced master degrees just to delay entering a broken job market. That decision pushes them deeper into student loan debt without guaranteeing a better job. Let us look closer at why government statistics seem so unreliable to regular people. Every month, the Labor Department surveys over 100,000 individual businesses. Many of these businesses send in their official staffing numbers late or not at all. Government economists must make educated statistical guesses to fill in the missing gaps. During summer months, large seasonal swings in school schedules make those guesses very difficult. 50,000 local education jobs vanished in July due to summer school calendar adjustments. Economists expect many of those education roles to magically reappear in the autumn months. However, statistical flukes cannot explain away the massive downward revisions to May and June. The economy actually added 103,000 fewer jobs than originally reported earlier. When you remove the noise, the average monthly job gain dropped to 34,000. That is a fraction of the pace required to keep up with population growth. Federal Reserve Chairman Kevin Warsh has maintained a stripped-back communication style with markets. He believes investors should form their own independent judgments about underlying economic fundamentals. However, the central bank is facing a dangerous dual-mandate crisis behind closed doors. Their primary job is keeping both inflation low and employment levels stable across America. Right now, those two goals are pulling the Federal Reserve in completely opposite directions. Inflation remains stuck at 3.5% due to persistent oil price shocks. To cool inflation, Fed hawks argue that interest rates must rise even higher soon. However, raising rates into a contracting job market could trigger a severe economic crash. If businesses cannot access affordable credit, hiring will freeze completely across all sectors. On the other hand, cutting interest rates could send inflation soaring back up again. The Fed is caught in a tight corner with very few good options remaining. This delicate balancing act is why Wall Street reacted so strangely to bad news. When the government announced 23,000 lost jobs, stock market futures immediately surged. Investors celebrated because they believed bad job numbers would stop interest rate hikes. Treasury yields plummeted as traders bet the central bank would hold rates steady now. It highlights a deep disconnect between financial markets and everyday working-class realities. Stock investors care about cheap central bank credit and high corporate profit margins. Working families care about paying for groceries, filling gas tanks, and keeping their jobs. When the labor market begins losing altitude, working families suffer the consequences first. We are seeing a labor market that is no longer acting as an anchor. Instead, it is entering a rough patch of unexpected turbulence near the ground. Tech executives love to tell investors that artificial intelligence is making their employees more productive. They claim that smart software simply helps regular workers do more in less time. But if you follow the money, a very different corporate story quickly comes to light. Big tech companies have cut nearly 140,000 workers so far this year. Major giants like Amazon, Meta, Oracle, and Microsoft account for 50,000 of those job cuts. That represents about 6% of their total corporate workforce eliminated in a few months. At the same time, these massive companies are spending obscene fortunes on artificial intelligence infrastructure. The four biggest tech giants expect to deploy over $700 billion this year alone. That money is going directly into building massive data centers packed with expensive graphics chips. Oracle plans to invest $70 billion to serve high-profile artificial intelligence clients. Wall Street analysts point out a harsh financial reality behind these massive corporate restructuring moves. The money to build multi-billion-dollar data centers has to come from somewhere. Companies are actively stripping cash out of payroll to fund their next big technological gamble. Oracle ended its fiscal year with 21,000 fewer employees after sweeping staff cuts. Yet, credit rating agencies still downgraded Oracle's credit rating to near-junk status recently. They cited weaker cash flows and lingering uncertainty over when artificial intelligence will pay off. Microsoft recently axed nearly 5,000 roles, mostly inside its gaming division. They reset that business unit just 3 years after buying Activision Blizzard for $75 billion. Tech leaders are simply abandoning old business bets to chase the newest shiny trend. Blaming artificial intelligence for massive layoffs also serves as a convenient public excuse for executives. It sounds much better to tell investors that software boosted efficiency than admitting past overhiring. Top economics professors from UC Berkeley point out that executives use artificial intelligence as an easy escape. They hide behind smart technology rather than admitting they made terrible corporate management mistakes. In fact, Wall Street is starting to see right through this clever corporate public relations stunt. Companies that cited artificial intelligence during layoff announcements actually underperformed the broader stock market. Their stock prices fell further than companies that blame traditional economic factors for staff reductions. That is why major firms like Amazon and Microsoft now publicly deny that AI caused cuts. This strange AI dynamic is playing out across the entire physical retail landscape as well. Look at what happened when Walmart held its massive annual employee gathering in Arkansas recently. Company executives flew in thousands of workers to reassure them about their retail job security. The chief people officer took the stage inside a loud basketball arena to cheer staff. She promised employees that technology would power the future while human workers led the way. The new chief executive officer even strummed a guitar on stage during the corporate rally. Yet behind the cheerleading, Walmart hired a specialized executive vice president for artificial intelligence acceleration. That single executive was paid $44 million in total compensation last year alone. That was actually more money than the company's outgoing chief executive officer received in total. At the exact same time, Walmart's tech and product design teams announced hundreds of layoffs. Store workers organized under labor groups petitioned shareholders for a formal report on artificial intelligence. A store employee testified that rushed rollouts of automated tools were creating impossible daily timelines. She warned that poorly designed software was causing workplace injuries, mistakes, and severe employee burnout. Employees asked for technology that works for human staff rather than working against them daily. Yet Walmart continues to push automated tools into inventory management and self-checkout systems. The retailer's stock price recently hit record highs, surpassing a massive $1 trillion market cap. Wall Street loves seeing retail giants squeeze human labor costs while spending big on tech. This corporate obsession with efficiency has created a deeply frustrating dynamic for ordinary job seekers. Economists now describe our current labor market as a strange no-hire and no-fire environment. If you already have a stable job inside a company, your position is relatively safe. Layoffs remain historically low because companies are terrified of running out of staff again. They remember the painful labor shortages that followed the pandemic lockdowns a few years ago. So employers choose to keep their existing staff even when business demand slows down significantly. But if you lose your job, landing a new role has become nearly impossible. More than 27% of unemployed Americans have been out of work for 6 months. That represents the highest rate of long-term joblessness seen in over 4 years. The pipeline into new employment is shrinking rapidly for workers standing on the outside looking in. In past economic expansions, employers eventually hired younger workers and people with less formal education. Today, researchers from the San Francisco Federal Reserve Bank found that process has completely stopped. Instead of pulling marginal job seekers into open roles, companies are shutting their doors tight. Even college-educated workers in their prime working years are struggling to land simple job offers. The situation is particularly grim for recent college graduates entering the workforce for the first time. Unemployment among young adults aged 20 to 24 without prior experience remains above 24%. The past 2 years have delivered the highest unemployment rates for new grads since 2016. Students spend 4 years earning expensive degrees, only to face complete silence from corporate recruiters. Staffing agencies report that software firms and call centers are cutting back on entry-level hiring. They prefer to produce more work using existing staff and artificial intelligence tools instead. That leaves an entire generation of educated young people stuck on the economic sidelines completely. To understand why everyday consumers feel so stressed, you have to look at real inflation. Headline government statistics claim that the labor market remains in relatively solid financial shape. But average hourly earnings increased by a pathetic 2 cents across the entire nation last month. That brings annual wage growth down to 3.2% for working-class families. Meanwhile, annual inflation is running hot at 3.5% across the broader economy. That means the average American worker is actually losing buying power every single month. The primary driver behind this renewed inflation spike is escalating military conflict in the Middle East. Ongoing fighting around the Strait of Hormuz has sent crude oil prices climbing past $90. Average regular gasoline prices in America jumped 36% to over $4 per gallon. Higher gas prices act like an immediate tax hike on every single commuting American worker. When families spend more money filling up their cars, they have less money for discretionary purchases. That explains why leisure, hospitality, and retail employers slashed tens of thousands of jobs recently. Lower-income consumers are running out of spare cash and pulling back on daily spending. This creates a severe divide that economists call a distinct K-shaped economic reality. Higher-income households continue to spend money freely and enjoy luxury vacations without any concern. Their stock portfolios and asset values keep rising thanks to record Wall Street market gains. But lower-income households face constant financial stress from expensive gas and high grocery prices. Tariff-driven price hikes on imported goods continue to squeeze family budgets across the country. Working families are running out of savings while accumulating high-interest credit card debt just to survive. There is another hidden force pulling workers out of the American economy every single month. Demographic shifts are shrinking the total size of the workforce at an unprecedented pace. Millions of older baby boomers are reaching retirement age and stepping away from work forever. At the same time, hardline government immigration policies have cut off the flow of new workers. The labor force lost over 700,000 workers in a single month earlier this summer. Economists point out that fewer available workers automatically keeps the official unemployment rate low. This shrinking workforce is causing severe strain in essential service sectors like healthcare and elder care. Over 20% of the American population will be senior citizens within the next decade. Demand for direct care workers, home health aides, and nursing assistants is exploding exponentially. Yet nearly one-third of home health aides in America are foreign-born immigrant workers. When immigration pathways are restricted, care facilities simply cannot find enough staff to operate. Squeezed budgets and potential Medicaid cuts threaten to push direct care worker pay even lower. We are facing an aging population with a shrinking army of underpaid care workers. All of these conflicting economic signals leave the Federal Reserve in a completely nightmarish situation. Central bank officials are charged with keeping inflation low while maintaining maximum sustainable employment. Federal Reserve Chairman Kevin Warsh has tried to remain patient and calm in public appearances. He prefers to let investors form their own independent opinions about underlying economic trends. But behind closed doors, central bank officials are deeply divided on what to do next. Several hawkish Fed governors argued that persistent inflation demands another aggressive interest rate hike. Before July's disappointing jobs report arrived, traders expected a September interest rate increase. But losing 23,000 jobs completely destroyed the argument that the labor market is booming. Raising rates now could easily push a fragile, slowing economy directly into a full recession. Yet holding interest rates steady allows stubborn energy inflation to continue eating away at paychecks. Wall Street traders celebrated the bad job numbers because it means lower interest rates ahead. Stock prices rose and bond yields plummeted as investors cheered for cheap central bank money. That reaction perfectly sums up how modern financial markets operate in America today. Wall Street treats bad news for working families as great news for corporate stock valuations. The headline unemployment rate looks low on paper, but the real story is much darker. Millions of discouraged Americans are quietly dropping out of the labor force out of desperation. Companies are cutting corporate staff to fund multi-billion-dollar artificial intelligence bets. Real wages are falling behind inflation, while essential living costs continue to climb every week. Understanding these hidden economic mechanics is the only way to protect your financial future today. Do not get fooled by simplified government headlines or cheerful corporate public relations speeches. The labor market is not booming. It is losing altitude while flying very close to the ground.